As India is recovering from third wave of corona, I request all of you to keep precautions and follow standard operating procedures. As we all know that our safety is in our own hands. So I request all of you to keep your hands sanitized, follow social distancing norms, and wear a mask. All of these are really necessary for your well-being. And today, as we all know, that we have gathered for this very important series where we are like discussing about certain income tax simplification transactions with a shift towards financial literacy. There's been a shift towards savings and investments. So it's crucial we get to know about the income tax implications. So we are back again with this very interesting and knowledgeable topic. And I believe knowledge shared today will be really helpful for the professionals in their practical implications. And now we can see that people have started joining already. So that's a good news. Good evening, Manmohan ji. Thank you for joining in. Hope everything is good at your home. So thank you for your love and support for joining in this day 2 of this session. It keeps driving us to try our best at what we do and keep you motivated. Keep using the chat box like you have been doing now so that we can make this session very much interactive. Good evening, Deepak ji. Okay, so we recently organized a webinar where we talked about unfolding the future of CA practice, where we discussed about future technologies like cryptos, blockchains, and forensic audit and their use cases in CA practice. So this was really a useful session because, as we all know, our technology and world is going towards these things. So I think we should all be aware of these and their use cases in our profession. If any one of you have missed it out or want to revisit it again, it is available on our Optotax YouTube channel. You can go and watch it as per your convenience. And now beginning with today's session, which is brought to you by Optotax, which most of our professionals are already aware of. But let me take a minute to give a glimpse about it to all of you. We are a technology and knowledge platform. And in our journey, we have always tried to make your GST compliance seamless and hassle-free. It has been engineered for your empowerment and benefit. And now Optotax has become one of the biggest GST platform with over a family of 60,000 plus tax professionals who trust Optotax for their 1 million plus clients. So you can also give it a try. And now coming back to today's topic, where we are simplifying income tax transactions on investment transactions, where we learn about taxation on sale of shares, hedging and its tax implications. And also we are going to learn about speculation. And now it's the time to introduce our faculty for today. CA Ujjwal Jindal ji. He has been a well-known professional on our platform and otherwise as well. So there's no formal need for introducing him, but still it will be my honor if I get this chance to introduce him before all of you. He's a first-class commerce graduate from Delhi University and an associate company secretary and a practicing chartered accountant as well, and has done investment foundations program certified from CFA Institute and completed various courses related to finance, valuation, taxation, accounting, budgeting, corporate law, auditing, management accounting, strategic management, and other legal and allied matters from renowned universities and institutes located around the globe. He is the founder at 𝐓𝐫𝐚𝐬𝐭 Chartered Accountants and co-founder at 𝐓𝐫𝐚𝐬𝐿 Legal LLP, and his experience in the field of direct and indirect tax laws as well, corporate laws, allied law, and capital markets. He is also a content writer at Taxman, CA Club India, Tax Group, newsletter, journals of ICI and ICSI, and also speaks and consult about tax experts and on various platforms. Such a great pleasure to have such a knowledgeable and multidimensional personality. And I and our viewers will be really keen and excited to hear from you because today's topic is also very interesting and looking at the background and knowledge. So it's quite obvious that you will be justifying the same. So don't want to take much more time, and straightforward, I'll hand it over to you so that people who have gathered here for your deliberation get to hear from you now. So over to you, sir.
Thank you so much, Rohit, for this wonderful introduction. And I would like to thank Optotax for inviting me once again for this session. It has been some time now that we had our webinar session because of the due dates and everything and the closing that was piled up. But even on a thin margin, we arranged for this session somehow because I found this topic to be very interesting. And secondly, it's always a pleasure to get connected with Optotax and do a webinar on such interesting topics. Also, I would like to thank Optotax for basically wishing me on my birthday so elegantly. It was all posted on the social media handles. I really liked it. So thank you so much for the gesture. And not taking much time, we are going to discuss everything about the investment transactions today, primarily focused on shares. Because if we talk about the number of securities that are there, we have to study the implications of tax about it. So there are so many securities, but this session is specifically curated for share transactions or the transaction of sale of shares that is happening and what are the income tax implications of the same. Secondly, we are also going to explore about the speculative transaction. There is a lot much controversy and confusion in the minds of even the professionals, even the people out there, that what transaction is speculative, how we have to show the capital gains. It is a capital gain or it is a business income. So in a way, this topic is very much interesting. So seeing from the past time, the investments in the stock market is rising like anything. The market is also up by more than 100 times now from where we started off. And even seeing the future of it, even the young generation, the young accountants, the young chartered accountants have entered into this field, and everybody is exploring it like anything. The investments, the SIPs, the mutual fund investments are rising at a great scale. And that is why there is a need to understand the tax implications in a profound detail, because that is where we will lag in the future, because all the clients that would be coming up to us, so they'll be carrying out various number of transactions. It could be sale, it could be transfer, it could be relinquishment, it could be exchange. So we should have a strong idea about what the transaction actually is, like how it is to be treated as a capital asset or it has to be treated as a stock in trade for business. So all of that we have to specifically be sure about. And in this session, we'll be focusing and discovering everything about it as per the agenda. So not taking up much time, I'll be starting up the presenter. See, I have kind of made a lot of material for everybody, so that in future also, if we are sharing these slides with anybody, so they are able to get a fair idea about how things could work on. But the session is in a way very much interesting, because beyond the slides also, I'm going to tell you certain aspects and certain things. So we'll be going on a faster pace, because there are many basic concepts also about capital gains that I have stated up. So I'll just give a quick reading about them and then keep running, because we have to focus on the primary aspects that are really important with regard to share transactions, be it the grandfathering concept or being it the bifurcation of a capital asset or a stock in trade. So we'll be focusing more on that. So here we start the presentation. It's income tax on investment transactions. These are my details. I'll share it in the end of the session as well. And here we begin about the scope and coverage of today's session. So it is primarily focused on detailed discussion on taxation on sale of shares under various heads of income. When I say various heads of income, that is just because we are not only going to cover the capital gains aspect, but also covering up the income from other sources on sale of shares. Now, how is this possible? I'll be going to discuss everything about it in the session. Thirdly, we'll be also covering up the PGBP impact of sale of shares transaction, because many of us are taking the shares as stock in trade, and that is why the income that is flowing up is going into a business income or a speculative income, and how the transaction has to be shown up, how things have to be drawn, and what will be the taxability. So everything we would be discussing in detail. So this is our primary head for the day. Second, as there is much confusion about speculative transaction, so we'll be understanding the meaning first of the speculative transaction along with taxation of these particular transactions. Why I have used the word transaction and not income? Because usually what we are doing is in income tax, we are taxing the incomes. However, in this particular case, I have used the term transaction and not income. I'll tell you the reason behind it, like why I'm using the word transaction and not income. And thirdly would be your round, that would be the question answers. Just 3 limbs for the session. We have over 50 slides, but only 3 things to discuss, because the first head, that is the sale of shares under various heads of income, the income from the shares, that is really vast, because it's a vast proviso, it's a vast provision, number of sets, number of sections, number of provisions. So let us start the discussion quickly. First of all, taxation on sale of shares, that is the primary head. We begin with the taxation on sale of shares with capital gains basics. So when I say basics, we'll be quickly going through it so that we understand the meaning of what is capital asset, what is transfer, what is cost of acquisition, how are gains computed, so that whenever in the future discussion we are using these terms, we are not unaware of the meanings of the various terms that we encounter in form. So talking about section 45.1, 45.1 is the charging section of capital gains. So the section states as under that if there is any profit or gain that is arising from transfer of a capital asset. So 2 words are important here. First is transfer. Second is of a capital asset affected in the previous year shall be chargeable to income tax under the head capital gains in the previous year in which the transfer took place. Quite clear with the definition, profits and gains, transfer. It should be a capital asset affected in the previous year, that is the financial year that is going on, shall be chargeable to the income tax under the head capital gains in the previous year in which the transaction took place. So in the same previous year in which you have executed either the sale or the transfer of that particular capital asset. So this goes the charging section, section 45, from where the essence of chargeability, like how capital gains will be charged, this essence flows by section 45, subsection 1. Next, we came around the terms, 2 terms, one transfer and second capital asset. So let us understand what capital asset is. Capital asset has been defined under section 2 subclause 14. It says capital assets mean. When we say means, it means that the entire meaning is profound. There is nothing left out in the meaning, and we have to just study the meaning of the capital asset to the extent that has been written up. There are certain terms used as includes, that is there in the transfer, in the definition of transfer. I'll just show you. So in that particular scenario, even the transactions or items that have been stated in that particular subhead, more than that transactions can come under this purview. However, when the meaning is written as means in the definition, it is clear that only these particular items will get covered and there will be no other item that will be covered up. So capital asset means property of any kind held by an assessee, whether or not connected with his business or profession. Property of any kind, be it movable, immovable, be it intangible, tangible or intangible, be it of any kind, being your self-generated, purchased, anything. So property of any kind held by the assessee, whether or not connected with his business or profession. And second, any security held by a foreign institutional investor, that is FII, which has invested in such securities in accordance with the regulation made under the SEBI Act 1992. So here we are talking about the Guild of Investors, term as foreign institutional investors, who have invested in the equity stock market of the country, like in the shares of all the companies that are there on BSE or NSE. And this has to be in accordance with SEBI, obviously, because the money that will be flowing in would be foreign exchange. So everything has to be under a regulated umbrella. So these 2 transactions or these 2 items would flow to mean what a capital asset is. And if there is any sale or transfer of this particular item, so capital gains would be arising and the taxation would be flowing in section 45.1. So coming towards this exception or the proviso that has been added in this definition, this particular capital asset definition does not include any stock in trade other than the securities referred to in second clause above. That is, wherever any FII is investing in the securities market in India, in that particular case, it would be always be a capital asset. It could never be a stock in trade. That is what the definition states, and even the exception makes it quite clear that but does not include stock in trade other than the securities referred to in subclause above. That is, the foreign institutional investors' investment into equity will always be treated as a capital asset and it will never be treated as stock in trade. Second is personal effects. Now, what we understand by the term capital assets, personal effects, is that movable property that is held for personal use, but it excludes certain items that are chargeable. So they are jewelry, archaeological collections, painting, drawing. So that are not of our concern in today's discussion. So just for the purpose of making up the entire scenario for the definition, I have covered this particular aspect. So we are clear with the definition of capital asset. However, just for clarity, I have added a limb in this particular discussion that why the shares of FII have always been taken to be a capital asset, because there could be a number of circumstances where even the FII would be trading in such stock and securities. Like the nature of the transaction would be a day-to-day transaction that would consist of buying and selling of securities on a daily basis, not taking their delivery, either being it of a speculative nature of an intraday transaction, of an FNO transaction. All these transactions would always be considered to be a capital asset for FIIs and not stock in trade. Why this purview has been taken up by the government? So this came up by the amendment by the Finance Act 2014. So 8 years back it came up. What was happening was FIIs are major investors in Indian stock markets since they are frequently buying and selling shares. The revenue authorities are treating the shares held by them as stock in trade and consequently treating their income as business income, attracting higher rate of tax. And on foreign investors or foreign entities or NRIs, the rate of tax goes up to 40% in case of companies, because they operate under a guild or an umbrella or a company format or a body corporate structure. So the tax structure, if goes into a business income kind of a thing, it goes up to 40%. However, FIIs are treating the share as capital asset, that is investments, and claiming benefit of section 1038, that is long-term capital asset being long-term capital gain being exempt. 111A, that is taxing short-term gains at a flat rate of 15%, and 112, that is taxing long-term capital gain at the flat rate of 20%. However, revenue authorities are denying these benefits, obviously because they are finding it the nature of the transaction to be recurring, and on a daily basis it is going like buying and selling. So they were classifying it as a business income nature transaction, and the FIIs were saying that we wish to take the exemptions or the deductions that have been provided by the government under these sections, and they are treating their particular capital asset as an investment instead. So just to end up this controversy, the government came up with an amendment where it says that if FIIs are holding any of these stocks, it will always be considered as a capital asset and never as a stock in trade. So if they are never as a stock in trade, they are never going to be treated as a business income and always a capital gain or a capital loss. And that is why stock in trade would never, for the FIIs, would never be in source in India. It would always be a capital asset. So this was just for a clarity. Moving ahead with our definition, capital asset is done. Now comes transfer. So in the meaning of transfer, we say it's section 2, subclause 47, and transfer includes. So now this is an inclusive definition. That is, even other clauses that are not written in this particular definition can come up in the future, or government could even call certain transactions to mean transfers. However, they are not written in this particular section. So when a definition is inclusive, a wider reach has been given to that particular definition for future coverage. So I have picked up the inclusive meaning or the meaning of transfer to mean what is relevant to our discussion, that is related to shares. So when we talk about it, the transfer includes the sale, exchange, or relinquishment of the asset. So when I call these three words, we are often understanding them to be one of the same. But if we understand this, now sale is what we know when we purchase something and we sell off. Exchange is barter, when we exchange a particular asset or a share against the share of another company. So that goes exchange. Relinquishment of asset is making it to an end, or the asset coming to an end. For example, if you are holding certain preference shares, if I call, so when the shares are buyback by the company because they cannot be issued for a term of 20 years in India. So say suppose a 5-year preference share has been issued up, and after 5 years the redemption is happening up. So whenever the redemption is happening up, what is eventually or actually happening is the relinquishment of that particular capital asset is happening, because your rights in that particular assets are going down up, and the money is coming back that you have invested in that particular share preference shares. So what is the relinquishment is also considered to be transfer, and the income that you'll be generating, that will be coming under the capital gain umbrella. So sale, exchange, and relinquishment are all transfers. The extinguishment of any rights there. So that is also wherever you have a right in a specific asset or a share class, and that right is getting extinguished either by the purpose of a buyback, or either the shares are getting delisted, or whatever the transaction is happening, that will depend upon the circumstances of each case. if this particular thing is happening, there is transfer, and the gains that would be arising would be classified as a capital asset, and eventually capital gain would arise. In case where the asset is converted by the owner thereof or is treated by him as a stock in trade of a business carried on by him, such conversion or treatment. So we understand that earlier it was being treated as a stock in trade, and now the transfer has been given effect to, and now it has been classified as a capital asset. So whenever this conversion or anything is going on, the gains or the items that are accruing to, because COA would be involved, sales consideration would be involved, and every time the gain that would be coming up would be classified as a capital asset and would always go into a capital based capital gain income or a capital gain loss. How the computations would be made, how everything would be made, we'll be studying it in next like few minutes when we are starting with the discussion. There are a number of items also that has been written, like zero coupon bond is also there. There have been certain property or immovable property transactions that are also included in transfers. So I have taken the meaning to mean just for the purpose of our discussion today. Okay, so transfer is clear, capital asset is clear, and the charging section is clear. So all the links of the charging section are clear. Now let us move ahead. So we talk about section 48 next. That is the method of how we compute these capital gains. That is sale consideration minus COA minus cost of improvement minus expenses that have been solely incurred for the purpose. So this all constitutes what at last comes up to be the capital gain or a capital loss. So sales consideration first, then goes the cost of acquisition of the asset, then goes the cost of improvement of the asset, then goes the expenditure wholly and exclusively in connection with this such transfer, and finally we arrive at the capital gain. Second proviso to section 48 talks about what we know popularly as indexation. So indexation is where the capital gain arises from transfer of a long-term capital asset. Then for the purpose of computing capital gains, we take cost of acquisition as indexed cost of acquisition, and in place of improvement, we take indexed cost of improvement. So these are some basics. What is long-term and short-term in case of shares? We'll be discussing it up. It is just the basic discussion that is going up here. So the methodology of computing the gains is clear. Secondly, indexation of these gains are clear, like the cost of acquisition or the cost of improvement, how indexation works out. How actually indexation is done? There is a CII table that is there. We all are aware about it. So we have to take the sales consideration, the CII of the current year and CII of the year in which we bought the asset. We just have to provide make a divide and a multiply operation, and there we go. The transaction or the resultant amount would be the index cost. So not much of a thing. Everybody is more or less acquainted with it. So fifth proviso to section 48. There are many proviso to section 48. So that is a major section basically to be considered. So it says Std not allowed as deduction. We all know Std is levied on any sale or purchase transaction that we execute through a recognized stock exchange, be it BSE or NSE in India. So Std is collected by the central government and is kept up on any purchase or sale transaction that is happening. Even on currency transaction, commodity transaction known by different name, Std is being collected up. So no deduction shall be allowed in computing the income chargeable under the head capital gain in respect of any sum paid on account of security transaction tax. So where this security transaction tax would have been allowed up if it would have not been disallowed. So in the head, expenditure that has been made exclusively in connection with the transfer of that particular asset. So there this could have been allowed, but this has been specifically disallowed. So we cannot claim Std as a deduction. Accordingly, the Std paid on sale of shares shall not be reduced from the sale price, and the Std paid on purchases shall not be added to the cost of acquisition. So whatever the treatment would be, you have to take it exclusive to the Std that you have paid. So that is yours. That becomes additionally your cost. However, if the shares are held as stock in trade, then Std paid on sale or purchase of shall be allowed as a revenue expenditure in the statement of profit and loss. So here we are classifying the shares as to be held in stock in trade, where the sale and purchase is happening on a daily basis, or the square of transactions are happening, the intraday transactions are happening. So in that particular scenario, whatever amount has been paid towards the Std, that can be allowed as a revenue expenditure. So this is a distinction that is consecutively we are studying two scenarios. One is the capital gain scenario and one is the business income scenario. So I am keeping it both on a parallel basis so that we like quickly understand the differences that are also happening in between. So we are clear with it. STT, if it's a capital asset, capital gain not allowed, business allowed, stock in trade allowed. Next, we are studying the period of holding now. So this is where we start up to classify the asset. Either it's a short-term capital asset or it's a long-term capital asset specific to shares. So we have this table. It says capital asset. Then it talks about holding period to qualify as short-term capital asset. So I have given just the means to classify this particular asset as a short-term capital asset. If it does not fall in this umbrella, it goes into becoming a long-term capital asset. Just that. So we have just studied or enumerated one of the dimensia, that is short-term capital asset, like how an asset or a share class would be considered to be a short-term capital asset. Shares of a company listed on a recognized stock exchange in India. So these are all the shares that we talk about, be it of Reliance, be it of ITC, be it of other companies. So if this holding period of a particular person is 12 months or less than that, then it would be classified as a short-term capital gain. The gain that would be arising from such particular asset, or the asset or the share would be classified as a short-term capital asset, STCA, or STCG would be the gain. If it's a share of a company that is not listed on any stock exchange in India, when we talk about this particular section, it says shares that are of public companies that are not listed, or even the shares of a private limited company, because they are not listed in India. Okay. Thirdly, we also talk about such shares of a foreign company that are listed on a stock exchanges outside India. So what we have to focus is not listed in India. So that classification would fall as short term only if the holding period is 24 months or less. So the difference is of a double, 12 months or less if it's listed, 24 months or less if it's not listed in India. Okay. So that is the major classification that we have to understand. Now, if a person is holding such stock for more than 12 months, it automatically gets classified under the long-term capital asset. And if it's a non-listed asset, non-listed share of any stock exchange in India, after 24 months, it goes on to becoming a long-term capital asset. So the classification with respect to long-term and short-term is the period of holding, and the period of holding is devised as 12 months or 24 months to be classified as short-term, and more than that to be long. So we are clear with the period of holding now. Next, let's study section 55 that talks about the cost of acquisition. So for all the shares that we talk about, there are a number of securities that we talk about, just not the equity shares, but there are the original shares that have been allotted, be it the right shares that are given to you by the company as a right, bonus shares that are given out of the reserves that have been accumulated over time, be it securities premium or some other reserves. So if the shares are given out of that is free of cost. So what would be the cost of acquisition and how the period of holding would start up? Renunciation of right is where the right shares have been provided to you, but you are not interested to take those particular shares and you renounce those particular shares in the favor of somebody else. So that talks about the renunciation of right to subscribe the share, where the shares has actually been entitled to you or given to you, but you are not interested in buying those shares. So you sell them to some other person and the other person gets it allotted in their name. So you are basically renouncing your right. And when we talk about renouncing your right, we talked about extinguishment of rights in that in the definition of transfer. So whenever renunciation is happening, you are extinguishing your right in somebody's favor. So when you are extinguishing that particular right, the capital asset or the nature of the transaction becomes capital gain. And section 45(1) would come in effect. So when we talk about original shares, the actual purchase price that you have paid and the holding period will start when the shares is actually allotted or purchased by. Right shares, price actually paid under the right issue. So this is a lesser price than the actual market price because it is given to you as a matter of right. So it starts up from the date of allotment. Then we talk about bonus shares that are given free of cost to the people who are already holding shares of this particular company. So the cost of acquisition automatically becomes nil. And it starts from the date of allotment, the period of holding. Then we talk about renouncement of right to subscribe shares. Now, this is where you are in the hand of the person who renounces the right. That is, you are not taking it up from the company and you are just being at a privileged situation that you are being offered those right shares, but you are selling it right away. So your cost of acquisition in this particular transaction becomes nil, and whatever you're getting it in return, so that becomes your sale consideration or the sale entitlement. So the period of holding for that particular transaction would be from the date of offer, because when the company has made you offer, the right has arisen, and that particular right is now getting sold. So we are here not talking about the share, but the right to purchase or right to have those shares. So right is getting sold up, so also capital gain is arising up, and this capital gain would always be a short-term one, because you are given a specific time to subscribe to these shares, and it is definitely lesser than 12 months. So it would always be a short term for the person who is selling up. And now we are talking from the perspective of the person who is buying these renounced shares, that is in the hands of the purchaser of the right shares. So price paid to the person who renounced the right, and amount paid to the company to acquire these right shares. So this in total would become the cost of acquisition, and the period would start from the date of allotment, just as in case of a original share. So now additionally, we have paid to the person who, in whose name the right was actually offered. We have paid him, and the base price of this particular right that was asked by the company. So together becomes the cost of acquisition. So this is the cost of acquisition for the shares we talk about under section 55. Moving up next is our primary discussion. From here it starts. We are ending with the basics now. So section 111A. 111A talks about taxation short-term capital gains in certain cases. It's not in all cases, it's in certain cases. So section 111A shall be applicable to all assessees, including FIIs and non-residents. When we say FIIs, including, it's understood, always their investment has to be a capital asset. And when capital asset, they have been given given this privilege to avail the benefits under section 111A or 11112 or 11112A. That is why FIIs are always taken along, and even the non-residents are. If all the following conditions are fulfilled. Now, what are these conditions? Starting with the first, the gain arise from transfer of a short-term capital asset. Now, short-term capital asset, 12 months or less, 24 months or less. Okay, just for the purpose of understanding, like because we have understood the period of holding just now. Being an equity share in a company, not applicable to other classes of share like preference shares, mutual funds or others. The transaction of sale is chargeable to STT. That is, you have to execute this transaction through a recognized stock exchange. If you are doing it off the market, privately, then this particular transaction would not be entitled. You will not be entitled to get the benefit of section 111A. Even a listed share can be bought or sold off market. That is through a bulk deal or through a private purchase agreement, that could be done. So if you are doing it, 111A is not available to that particular transaction. Section 111A is applicable if the sale transaction is chargeable to STT. STT applies to sale of equity shares on a recognized stock exchange. No STT has to be paid in respect of a transaction undertaken on recognized stock exchange located in the International Financial Service Center, IFSC, where the consideration for such transaction is payable in foreign currency. On such sale, benefit of 111A shall be available. So even in these particular transactions in the IFSC, where the exchange is located up, so this is specifically meant for certain zones that have been made up by the government. And whatever transactions are happening, even the STT is not getting levied, and even then the benefit of 111A is being passed. So this is a specific exclusion that is there. Okay, not much of a resource to us, only to applicable to people whose clients are actually dealing up in the IFSC. Only to them this particular provision is applicable. To all others, the general law is applicable. That I just. So continuing with 111A, tax on short-term capital gains in certain cases. So tax would be payable on such STCG at the rate of 15%. A discounted rate has been allowed because if you go up on adding this income to your specific slab, then you might be taxed at 20%, 30%, and likewise. So a flat rate has been given at the rate of 15%. For claiming benefit of 111A, assessees have to establish that they were holding the equity share as capital asset and not as stock in trade. Obviously, you have to establish that the premise of your asset is a capital asset and not a stock in trade. That is, it is not a business income or a business asset. And that is where you get the benefit of 111A. Now, here I mentioned excluding FIIs. As I already told you, FIIs would their shares would always be considered to be a capital asset. So they are never going to ask for such establishment that even the FIIs has to establish that their securities are like not stock in trade. They have to never establish this particular fact. All others may be asked to establish this fact that they are holding these shares as capital asset and not as stock in trade. Preference shares are not covered under the preview of section 111A. Already made clear that it is specific to equity shares on a recognized stock exchange. Benefit of slab rate is available on such STCG in case of resident individuals or HUF. That is not available to non-resident. So in case of non-resident, the basic exemption slab limit, that is of 2.5 lakh. So that is given up to the individual residents and to the HUF as they flow. So if your total income comprises of short-term capital gains, and the total short-term capital gains that are coming up are under 2.5 lakh or more than 2.5 lakh. So first, that particular benefit of 2.5 lakh would be given to you, and then 15% on that particular exemption, the 15% on that particular transaction would be taxed as STCG. So the slab rate benefit would be passed on to you. So there are certain incomes on which a flat rate transaction is applicable. The slab benefits are never given. For example, in case of income that you earn from the lottery. So in that case, you are taxed at a flat rate of 30%. Even if you are earning a zero income in the entire year, that is where you have the slab available of 2.5. Like even then you have to pay that particular 30%. But in this case, the slab benefit goes on to be available. But as the slab is not available to non-residents, like in general cases, so here also the slab benefit is being denied up. No chapter 6A deduction is allowed on STCG under 111A. Only the benefit that is already been given, there is quid pro quo. A lesser rate of tax has been given up, so they'll not give up also the deductions. So they'll majorly give up the slab benefit. That is also a bigger relief. So 6A has not been given. So that is how 111A works out. STCG other than referred to in 111A shall be taxable at normal rates applicable to the assessee. So that goes up by the slab itself. There are no certain slab, the tax rates that have been defined up for STCG other than 111. So that is where we conclude 111A. Now we are talking about taxation on sale of shares that are long term. We are moving to section 112. So tax on long-term capital gains, section 112 shall apply to all assessees, including non-residents. So here also the benefit has been extended to non-residents. In case of non-resident, LTCG on unlisted share is taxable at 10% without applying the first and second proviso to section 48. So here a specific benefit has been given. The rate of 112 is, however, 20%. But if a non-resident wants to avail of a benefit, they can pay a lesser amount of tax at the rate of 10%. In return, what they have to sacrifice is they do not have to take the indexation benefit. That is the second proviso to section 48. And without applying even the first proviso to section 48. Now, what is this first proviso actually is? Now, this talks about whenever a person is buying shares in foreign currency. So there is a certain exchange rate matrix that have been defined up by the government under this first proviso. So what the rates have to be taken, they are taken as TTBR or TTSR, like telegraphic transfer buying rate or the selling rate. And accordingly, these gains are a write-off. So what that particular proviso does is it takes off the exchange fluctuation that is being happening and the actual gain is being accounted for. Because you know, whenever you are dealing in foreign currency, there could be a situation where the forex earnings could be higher. And you are not being liable to pay tax on such foreign exchange earnings that you make, like because of the currency differences. So to nullify that particular implication, a system has been devised up in first proviso section 48, where they have given up that following that particular aspect, the exchange fluctuation would be denied up, and whatever the actual gain would be coming up in Indian currency, the benefit would be given up. So to non-resident, if they are dealing in unlisted shares, this particular benefit at the rate of 10% under 112 would be given if they forego all those benefits, all the two benefits of indexation and the first proviso that have been given to them. And then the tax rate could be make a 50% lesser than what is applicable under 112. So this is this particular provision. On long-term capital gain, otherwise, tax is payable at the rate of 20%. So that is why a differential or lower tax rate was applicable on the second sub-item that we studied out. Section 112 shall not apply where section 112A applies. So we are quickly studying up that 112A also. So that is the recent addition by the Finance Act of 2018. So where 112A would come in picture, 112 would not be in picture. Benefit of slab rate is available on such LTCG in case of resident individual or HUF, that is not available to non-resident. Same clause as studied in section 111A, same flows in section 112. Chapter 6A deduction shall not be allowed on LTCG, just like it was not allowed in STCG. Okay. So now we are studying the proviso to section 112. We are continuing with section 112 itself, but we are now going ahead with the proviso. So tax on LTCG from listed shares, okay, applies to all assesses, including the non-residents. Any LTCG arising on transfer of listed share shall be taxable at lower of. This is an important provision. So I must tell everybody to just focus on this provision. So first of all, it applies to all assessees, including the non-resident. Second, any assessee arising, any LTCG arising on transfer of listed shares shall be taxable at lower of 20% of LTCG after indexation, if applicable, or 10% of LTCG without indexation. Second proviso to section 48 is indexation. So 10% of LTCG without indexation. So this benefit is being extended to all the assessees now. Earlier it was to the non-residents. So proviso says that even if a resident Indian wants to avail of the benefit of paying tax at the rate of 10% on listed on sale of listed shares, it can opt in. However, it has to sacrifice the indexation benefit. Now, whether indexation is being actually provided for when we are dealing it with the listed shares, let us understand that if listed shares are sold on stock exchange, then LTCG is taxable under section 112A. Again, this benefit has been taken back with this statement, because the premise of this section stated any LTCG arising on transfer of listed shares. Listed. Now they say if the listed shares are sold on stock exchange, then LTCG is taxable under 112A. So if the listed shares are sold off market, that is not through stock exchange, then proviso to section 112 would come in picture. Otherwise, if through recognized stock exchange, then 112A would come in picture. Proviso to section 112 applies where listed equity shares are sold other than through recognized stock exchange. In case of non-residents, for computing capital gains arising from off-market sale of listed shares of an Indian company purchased in foreign currency, like we just studied when I was discussing section 112. The first proviso to section 48 applies, and the second proviso does not apply. So in the first proviso, it has been provided up. In the second proviso, it has been stated that where a person has availed up this first proviso, the second proviso is simultaneously not available to him. And where for the non-resident, obviously the exchange fluctuations could be higher, and they are mostly taking up the benefit of first proviso to section 48. So we are talking about off-market sale of listed shares for them who have purchased this share in foreign currency. So first proviso of section 48 applies, and the second proviso does not apply. Thus, in terms of proviso to section 112, in case of non-resident, the tax on LTCG from off-market sale of listed shares purchased in foreign currency shall be 10% after applying first proviso to section 48. For the non-resident, a benefit has been extended by a proviso to section 112 in a way that even if this sell shares off market that are listed shares, even then the benefit of first proviso and the reduced tax rate of 10% would be given to them. In 112, they said 10% is available to a non-resident only when the first and second proviso benefit is given off. However, proviso states that this benefit would be available to transfer of listed share at the lower rate of 10% without indexation. So it says without indexation. It does not talk about first proviso to section 48. So in substance, reading both the sections like coherently or together, what we devise of is the non-resident selling of listed shares off market, then first proviso benefit plus 10% of the 10% tax rate benefit can be availed of together for that particular person. So that is where proviso to section 112 is specific for non-residents and not for other people, because other people are mostly executing these transactions through recognized stock exchange, particularly in listed shares. So that is where this finds less resource to the resident individuals. Otherwise, for non-residents, it's a boon. Next, talking about section 112A. So section 112A is tax on long-term capital gain in certain cases. So being 112A, it's an additive that came in from 2018. So what was there in this section was a grandfathering concept. it talked about the previous exemption that was given to the long-term capital gain on on sale of long-term capital asset being shares. So that has been taken back by this particular section. And now all those particular transactions are being given to be taxed at a rate that has been given up in this particular section. And how the things would be worked up, we will be starting up. So exemption under section 1038 shall not be available from AY 1920. That is financial year 18-19. We are talking about from starting from that particular time till date, the benefit of 1038 shall not be available. Now, what was 1038? Any gains that would arise from sale of long-term capital asset being equity shares. Okay, it also stated about units that are sold through the recognized stock exchange in India and STD was paid on them. Then the entire gain that was getting generated on that particular capital asset was exempt. Section 10 is always mostly about exemptions that have been offered up. So that gain was exempt, but now the exemption has been taken back and new rules have been defined up by this particular section 112A. So 1038 shall not be available from AY 1920, that is financial year 18-19. Section 112A is applicable to all assesses, including FIIs and non-resident. This section is applicable from AY 1920. So even on the FIIs and non-resident, this taxing provisions have been applied in for. Even they have to pay tax on long-term capital transfer of long-term capital asset being shares. Section 112 is available to an investor who holds the equity share as capital asset and not as stock in trade. Whenever we are talking about 112A, we are always in the capital asset cycle that we are talking about, not the business income. So the particular classification has to flow in for capital asset and not as stock in trade. So hence, assessee claiming benefit of section 112A will have to establish that they were holding the equity shares at capital asset and not stock in trade. This has to not be done by the FIIs because for them, they'll be always considered to be capital asset as we studied before. So section 112A overrides 112. So wherever 112A would be applicable, 112 would become redundant. However, if section 112 is not applicable because of non-compliance with conditions of section 112A, then section 112 would come in picture. So there are a certain set of conditions or applicability that flows up to 112A. We'll be studying up in the next slide. So whenever if you fulfill those applicabilities, then you have to stay in with 112A. If they are not getting fulfilled, that is, this provision becomes redundant, then we'll be moving back to 112. Okay. The benefit of first and second proviso to section 48 shall not apply while computing LTCG under section 112A. So no indexation and no protection against foreign exchange fluctuations to the foreigners. Okay, to the non-residents or the foreigners. So both the benefits have been withdrawn up. Coming towards what are the conditions for applicability of section 112A. So first condition we are talking about, this has to be satisfied cumulatively, that is all together. The total income of the assessee includes income chargeable under the head capital gain. Obviously, we are transferring a long-term capital asset, so income has to arise under the head capital gain. The capital gain arises from transfer of long-term capital asset being an equity share in a company. Again, equity only. We are not talking about preference shares or other securities. It has to be only equity. STT has been paid on both acquisition as well as transfer of shares. That is both on purchase, acquisition and on sale or transfer. Some exception provided for STT on acquisition of equity shares. These exceptions also I have covered up, but for the time being, you have to understand that it should be paid both on the purchase or the acquisition and the sale or transfer. Section 112A is not available for preference shares. Already made it clear. Section 112A applies to all listed equity share, whether regularly traded or not regularly traded. So there are stocks on stocks that are listed on stock exchanges that are not in regular trading activity. So the trades get done within 15 days, within 10 days. There are also stock locks that are there on for certain stocks. That is, they are allowed being trading in certain days only of the month. So even to all those classified shares, because there are provisions, 50 CA is there, that is not talking about that talks about quoted shares that are not regularly traded. So making it clear, so 112A is available to all listed shares. So there is no distinction, even if they are not regularly traded. 112A would flow up. So these were the conditions that we were talking about. If they are all cumulative satisfied, then 112A would be applicable and 112 would not be applicable. Now we're talking about the conditions on STT. That was I talking about the exemptions that are available on STT. So first we'll be talking about the conditions on STT on acquisition. So this flows only for equity shares acquired on or after 1st of October 2004, because that is when STT actually came in. So section 112 shall be available if equity shares were acquired before 1st of October 2004 in any manner, because there was no STT. And if you are still holding shares that you have bought before 1st of October 2004, there could be n number of situations in which people could be holding this share. So in that particular case, even if you are selling these shares under section 112A or in the market through recognized stock exchange, and you have not paid STT on the purchase or acquisition because it was not applicable, even in that particular case, section 112 benefit would not be denied, and you will be made, those benefits would be made available to you even when you have not paid STT on purchase. Condition of payment of STT on acquisition is therefore not relevant for shares that have been acquired before 1st of October 2004. Now talking about class of shares that were acquired on or after 1st of October 2004 and STT was paid on acquisition of these shares. So this is very clear. In that particular case, you have already paid up for the purchases and now you'll be paying it up on sale and 112A would become applicable. However, central government has notified certain acquisitions made after 1st of October 2004 which will be eligible for the benefit under section 112A even if STT is not paid on the acquisition. So there has been certain set of transactions that have been notified, most generous being the IFSC one, so that if the exchange is there, if the STT is not applicable, even then 112A is applicable or to those particular persons. So there are certain conditions. So in these conditions, even if STT is not paid, the benefit of 112A would not be denied. Condition on STT on sale. This was on acquisition, now on sale. Section 112A is available if the sale transaction is chargeable to STT. So sale transaction has to be mandatorily charged with STT in order to obtain 112A. There is no exception that is there. So on the sale, on the acquisition part or the purchase part, there are two exceptions, but on the sale part, there is no exception. Section 112A shall not be available to capital gains pursuant to buyback, sale of right entitlement, delisting shares, negotiated deals, etc. So specific citations have been made by the government that if STT is not paid on sale of shares, so the nature being buyback, the nature being right entitlement, the nature being delisting shares, the nature being negotiated deals that are carried off market, no STT, no 112A on sale. Okay, so it is very much clear. So STT portion is also clear with our discussion. Now talking about section 55(2) AC, that is cost of acquisition in case of capital asset is acquired before 1st of February 2018. So that is what we were talking about, the grandfathering concept or the grandfathering provisions. So what are these grandfathering, or whenever I call grandfathering provisions, what are they actually? If anybody is interested in answering. Okay, let us get to the discussions at the end of the session. I guess in between, everybody is interested more in looking at the presentation and also hearing to what I'm saying. Okay, so grandfathering provision, what we talked about is certain portion of your gain being exempted, ruled up, squared up. That is what we call up with the grandfathering concept. That at till a particular certain set, your gains have been offed up, or they have been squared up, or they have been ignored completely. And starting from the very next day, whatever it is, whatever the government has given up, your gains would now start to accrue. Even the losses of that particular time, like when we talk about the grandfathering concept, even those losses are not given to you. So incomes and the losses both are squared up, and now it's a fresh start that is going up, that would be happening. So whatever the rates would be as on the last date when the grandfathering provisions would apply, so that rate or your actual buying cost, whatever it was, whatever was higher, would be given to you. Whatever your sale consideration, FMV, the lower would be taken and the higher would be considered up. I will be sharing the formula what it is, so that the losses are also not allowed to you. Okay, so this is where we talk about the grandfathering concept. So the cost of acquisition shall be higher of A and B below, higher of A and B below. A being the cost of actual acquisition of the asset, like for what you have actually bought the asset for, and the lower of the fair market value of the asset that we are talking about is mostly on 31st of January 2018, because the grandfathering concept was made applicable from 1st of February. So taking the last date back in time, so that becomes 31st of January 2018, and the sale consideration. So what we have to take higher of is A and B, and lower of 1 and 2. So firstly, we'll be doing lower of 1 and 2, and then out of which the lower will be selected. The lower and the A part, that is cost of acquisition, will be taken up, and then the actual cost of acquisition would be arrived at. We have curated an illustration, detailed illustration for section 112A for your reference. After that, things would be very smooth for everybody. So this is the formula, higher of, lower of. Okay. Cost of acquisition in A above shall mean the cost of acquisition to the assessee or the previous owner from whom you have acquired that particular asset or that has been given to you, and where the asset was acquired by the assessee or the previous owner before 1st of April 2001. The cost of acquisition to the assessee, previous owner, or the FMV as on 1st of April 2001, whichever is higher. So basically 2001 has been selected as the base year now. So if the asset was purchased before that particular base year, so you can take either the higher, obviously you'll be taking up the higher cost, because even only in that particular scenario, your gains would be lesser. So higher cost of acquisition is what you have paid in for actually, or what was the cost to the previous owner, or the FMV as on 1st of April 2001. Higher of the two you'll be selecting as your cost of acquisition or this particular transaction. And then finally you'll be coming up to the grandfathering concept, that is the cost of acquisition under 112A. Okay, so first cost of acquisition, the A part that we have talked about above, so that would be taken up as the initial cost or the FMV as on 1st of April 2001, and then the lower of would be demarcated. Okay, so now just giving you an insight on how we have to compute the FMV. The FMV as on 31st of January 2018. So this table is enough like to understand what the FMV we have to take. So shares listed on a stock exchange as on 31st of January 2018. We are talking about those listed shares. So assets quoted on such exchange on 31st of January 2018. That are the shares that are quoted on this particular stock exchange. So you have to take up the highest price that has been quoted on the stock exchange as on 31st of January 2018. And where there is no trading, as we talk about, 112A is applicable on such shares also that are being not regularly traded. For that particular segment, they are listed but not regularly traded. For that particular segment, where there is no trading as on 31st of January 2018, highest price of the asset on the stock exchange on a date immediately preceding 31st of January 2018, when such asset was traded on such exchange. Now this date could be even 30th of January, 25th of January, 20th of January, 1st of January, whatever the date it could be. So it can be when the asset was last traded. So 112A is available both to assets that are shares that are regularly traded and that are not regularly traded. FMV has to be applied for following this particular matrix. Okay. Coming next is section 1038 with section 112A. Now section 38 was giving exemption from long-term capital gain previously. So now section 112 is applicable if capital asset is sold on or after 1st of April 2018, because it came up with the Finance Act of 2018. So the provisions were becoming applicable from 1st of April 2018. Now say suppose a circumstance if the asset is sold on or before 1st of April 2018 up to 31st of March 2018. That is, there is any sale of asset that is happening in the financial year 1718. So in that particular case, 112 would not apply. And whatever the long-term capital gains would have been coming up from to that particular time would be continued to get exempt under section 1038. So 112A would not flow to transactions that have been squared up, concluded as on 31st of March 2018. They'd only continue to transactions where a person continues to hold such shares after 1st of April 2018 and the sale is happening there. Okay, so just for an insight, I have included this particular one. Computation of tax, what taxes we have to pay under 112A? Simple again, the amount of LTCG covered by section 112A. Up to 1 lakh, there is no tax. Even before time, if we talk about, so earlier under 1038, there was absolutely no tax, not up to 1 lakh, there was no limit. Now government has added up a limit. There is still exemption that is there, but that has been limited to 1 lakh rupees. So up to 1 lakh of LTCG, no tax. Exceeding 1 lakh, you have to pay 10%. So 10% is the tax rate, and no indexation, no other benefit of first proviso to section 48 is available. What you have paid for, what you have, and whatever you are getting in return on the sale, you have to pay minus 1 lakh into 10%. That is your LTCG and simultaneously your tax that is being worked out. So this is where we talk about everything about it. So now coming to section 50 CA that I was discussing, that where they already talk about the shares that are not regularly traded up. So I have taken 50 CA vis-a-vis section 112A as well. So section 50 CA applies to unquoted shares and quoted shares that are not traded with regularity from time to time. So 50 CA is a section for capital gains only. So it talks about or applies to unquoted shares that are shares that are not listed on a stock exchange, and even for shares which are quoted but not traded on stock exchange. In such a case, the FMV of the shares is deemed to be the sale consideration for the purpose of section 48. Section 48 is for computing the long-term capital gain. The methodology has been given up, or for the purpose of indexation also, or for the purpose of first proviso of section 48 also. So that is where it has been given. So it says that if it is not available, so we'll be taking up FMV. Okay. But on the other hand, section 112A applies to all listed shares and does not distinguish between regularly quoted or traded shares and other shares. Hence, it will apply to the capital gains that would be arising on transfer of quoted shares not traded with regularity. The combined effect of section 50 CA and section 112A in respect of such shares which are not regularly traded but are listed on the stock exchange for section 112A will be as follows. Now, what will be this effect if we read both these sections together? Sale consideration has to be determined in accordance with section 50 CA. Obviously, that sales consideration has to be given effect to the FMV that is there. Okay. Second, cost of acquisition has to be it has to be worked up as per section 55(2) AC. That is as per section 112A, the cost matrix that we have worked upon. Okay, and lastly, the resultant CG would be taxable at the rate of 10% after 1 lakh exemption under section 112A. So FMV of the sale consideration goes as per the laws that have been stated in 15 CA. Now, what has been stated actually in 50 CA is to take the actual value or the FMV of the shares by following the rule that has been given, that is 11 UA, for working out the value of the equity share of that particular company if it's unlisted, if it's not regularly traded in stock exchange. Okay, we are talking about that particular cycle only. And for the cost of acquisition, whatever I have just covered in 112A, the entire matrix for the computation of the cost, so that has to be worked up by 55(2) AC, and then the resultant gain would come up naturally under 112A, that is 1 lakh would be exempted and another part would be taxable at the rate of 10%. So that is how 50 CA and 112A clubs or goes on together for shares which are quoted but are not regularly traded on the stock exchange. So the combined reading would work somehow like this. Now, I guess we are coming up to exemptions, set off and carry forward of losses under 112. So talking first about the exemptions. So whatever the exemptions have been given under the capital gains basket, that is 54 EC, EE or section 54F, shall be available in respect of LTCG that has been referred to under section 112. So that would not be denied. However, section 10, chapter 6A deductions would not be there. Rebate would not be there under 87A. So the exclusions would work out specifically. There is no a bucket that has been given that all exemptions have been denied up. Only specifically chapter 6A and the rebate that has been specifically denied up. Other deductions or exemptions that are there, like under 54F or there are 54 EC or 54 EE, that would continue to get accrue even if you opt in for section 112. If there is a loss under section 112A, then such loss shall be set off and carry forward as per the sections 70 to 80. So general set off and carry forward provisions as are applicable to long-term capital gains or long-term capital losses would be applicable here. Losses, short-term or long-term, can be set off against the LTCG referred to in section 112A, and balance LTCG shall be taxable at the rate of 10%. So nothing has been done away with under, if we talk about specifically about what the losses or the set off or the carry forward, it remains the same just as in it was 112 long-term capital asset. The exemptions are there, the deductions are there, and even when you are finally paying up under 112A, you have to set off or carry forward the losses that earlier you were carrying as long term, because long term goes up with long term, and on the balance you have to pay 10%, and 1 lakh exemption would also accrue. So after 1 lakh you have to compute in for this particular loss, and on the balance you have to finally pay that 10%. So this talks about exemptions, set off, and carry forward. And let us now understand this concept much in detail by this quick illustration. So Mr. X acquired the equity shares on 1st of January 1999 of ITC Limited for 10 lakh. So this was the actual cost of acquisition. FMV of these shares as on 1st of April 2001 is 11 lakh. So that is our base year. And FMV as on 31st of January 2018 is rupees 20 lakh. Okay, that is for the grandfathering purpose. So Mr. X sold these shares on BSE on 10th of April 2018. That is after 112A was given effect and the grandfathering provisions were coming in. So case 1 is where he sold these shares for 25 lakh, second 19 lakh, third 8 lakh. First of all, arriving the cost of acquisition. So cost of acquisition, we have studied either the cost, initial cost, or the FMV as on 1st of April 2001, whichever is more beneficial to the assessee. So that would be always be the higher one. So 11 lakh is your cost of acquisition, like the initial cost of acquisition. Secondly, we have now the FMV, that is on 31st of January 2018, that is 20 lakh. And third, we have the sale consideration. Now we will evaluate this particular solution with these three figures itself. In this case, the condition of section 112A are satisfied, and therefore second proviso to section 48 shall not apply. That is, indexation will not be done, obviously, because 112 is in picture. So before computation, let me quickly show you that how we have applied for the COA. So let me show you the, just give me a second. Okay, I guess the COA slide has been shuffled up. Okay, so we'll be quickly understanding the solution here. So sales price in first case is 25 lakh. In the second case, it is 19 lakh. And in the third case, it is 8 lakh. So this is very much clear. COA, that is what the COA will actually become. So let us now quickly understand it ourselves. In COA, we have already arrived at a COA of 11 lakh. Secondly, what I discussed about is the lower of FMV or the sale consideration. So lower of the FMV is 20 lakh. Okay, sale consideration is 25 lakh. So what becomes the lower of the both is 20 lakh. So now higher of the cost of acquisition, that is 11 lakh and 20 lakh. So the higher is 20 lakh. That becomes your cost of acquisition in case 1. Talking about case 2, again lower of FMV or the sales consideration. FMV is 20 lakh, sales consideration is 19 lakh. Lower of 19 lakh and 11 lakh, whichever is higher, becomes 19 lakh. In third case, the FMV, again 20 lakh, or the sales consideration being 8 lakh, whichever is lower, 8 lakh become your the lower of the lower of the two. And then the cost of acquisition, that is 11 lakh and 8 lakh. Higher of these two, 11 lakh becomes your COA. And that is how we have arrived the COA in this particular table that we were studying. So in first case, it was 20 lakh. Second case, it was 19 lakh. Third case, it was 11. 25, 19, 8 is the sale. LTCG, 5 lakh, nil, 3 lakh. In first scenario, 5 lakh minus 1 lakh, there is exemption. 4 lakh into 10%, tax under 112A becomes 40,000. Second case, 19 lakh, it's all squared up. No, there is no profit, no loss. In third case, there is a loss of 3 lakh rupees. Now this 3 lakh loss can be set off and carried forward. Very much clear with section 112A. I guess we must be having a slide of this cost of acquisition working. If it comes up, yeah, I guess it got shuffled while I was making up. So now let us take a break of just 1 minute. Let me have some water. So you guys can quickly give me your questions if there are any, or you can write up those particular questions. So we'll be back in exactly 30 seconds. Okay, so it was a quick water break. This is the first time that I have ever taken a break during a presentation, and that is purely because of the summer season that is there. So we need little of water to continue. So we are done with the 111A. We are done with 112. We are done with 112A. Now let us move towards the other aspect that we were talking about, that is taking shares as stock in trade. Then we'll be moving towards income that could arise in income under other sources, then towards speculative transactions, and thereafter we will conclude. So the CBDT circulars are there defining these particular aspects. So we'll be taking up these CBDT circulars now. So the first circular talks about clarification by CBDT on issues whether shares are capital assets or stock in trade. So this is the biggest controversy. However, I don't know why this controversy is in place, because this circular very much came in 2016, and it is so detailed, so much detailed and so much explanatory in itself, that the entire process of your classification would get vindicated. However, even now, I don't know how actually that even we are still in a fix that whether this particular asset is a capital asset or stock in trade. So even today, even if you are in a dilemma, that whether you have to you find difficulty in deciding up for your client that whether your particular stock or share is basically a stock in trade or a capital asset, today it will get nullified for sure. So CBDT clarification, this is a 3.3 step based circular, starting with the first one, that is CBDT clarification on listed shares and security, that is circular 6/2016. So this is the sixth circular of 2016 that has been issued, and it is available on the incometaxindia.gov.in website also. You can check up there. So where the assessee itself, irrespective of the period of holding the listed shares, opts to treat them as stock in trade, income arising from transfer of such shares would be treated as business income. So this circular says that it is on the assessee to decide whether his shares, even after being listed, are being taken up as stock in trade or they are being taken as a capital asset. So this particular assessee has to basically make a decision himself, ignoring all the concepts of capital assets that were there, the period of holding, or whatever the shares are listed or unlisted or unquoted. He has to make this decision. He has to follow this practice. And if he makes a practice to classify them as stock in trade, they are the income that would arise from such transfer or sale of such shares would be their business income. In respect of listed shares that have been held for more than 12 months, if the assessee desires to treat the income arising from transfer as capital gain, the same shall not be put to dispute by the assessing officer. However, this stand, once taken by the assessee in a particular AY, shall remain applicable in subsequent AYs, and the taxpayer shall not be allowed to adopt a different stand in subsequent years. So what they are talking about is, you are given the liberty to decide for your long-term capital assets that whether you wish to keep them, treat them as your investment or as your stock in trade. Once you have taken a decision to treat them in either way, you cannot switch a method in the subsequent AYs. You have to follow that particular method that has been given to you. This is similar to what we say presumptive income, because in presumptive income also, if you have selected the calculations to be under a presumptive bracket umbrella, so you have to remain in that particular umbrella, and you cannot jump up with the normal. You can jump up with the normal, but you cannot go back in time with the presumptive. So here they are saying, if once you treat them as a capital asset, then again you cannot treat them as a stock in trade. So there could not be a switching in, like whatever is beneficial to you has to be decided at only once in time, once in a particular assessment year, and not one time and again. So this has to be in place. Next, in respect of listed share held for 12 months or less, that is short term, and income is shown as short term capital gain. The nature of transaction, that is whether the same is in the nature of a capital gain or business income, shall continue to be decided, keeping in view of the circular of 4/2017 to 4/2007. So this circular 4/2007 is the basic or the primary circular that came back in time in 2007, and this circular is really detailed in defining that what becomes your stock in trade or what becomes your capital asset, or in fact you can even hold both of them together. How? We'll be discussing that in some time in circular 4/2007. But circular 6/2016 is clear that you have to decide, you have to choose once in a particular assessment year, and if it's short term, then how you have to decide that particular thing, that is also coming up. So for the long term, it is very much clear. For the short term, we have to see the nature of transactions. So whether it is business or it is a capital asset, and accordingly we have to decide. So now coming to the second aspect of clarification by CDT, that is CBDT clarification of unlisted shares and securities. First was listed share and security. Now we are moving to unlisted share and securities. Income arising from transfer of unlisted share would be considered under the head CG, irrespective of period of holding, with a view to avoid dispute, litigation, and to maintain uniform approach. So they have very well said. In case of listed, you have the liberty to choose, but in case of unlisted, it is a capital asset always. Okay, no disputes, no ambiguity, nothing. And it is also in the if we see in the general fundamental concept also, if we are treating it as a capital asset, it is all correct in that. So board circular number 4/2007. So this is the third limb or the final limb of our discussion in this particular CBDT circular that is coming up. This is the primary circular that we were talking about, that will clear up all the controversies that were coming up in deciding whether a particular share is a capital asset or a stock in trade. So in respect of listed shares held for 12 months or less, that is short term, and income there is shown as STCG. In deciding whether the shares are capital asset or stock in trade, the following should be considered. Okay. The treatment which assessee has given in books of account, that is whether shown as investment or stock in trade. So the premise of this would be how the assessee is treating his income. Either he is showing them as investment and claiming 111A, or he is actually considering them as a business transaction or a stock in trade. That is, he is time and again buying and selling those particular shares. So the books of accounts becomes a one fine factor to decide whether it is stock in trade or it is a capital asset. Second, the existence of power to purchase and sell shares in the memorandum of association, say it is a company MOA, is not decisive factor that it is stock in trade always. Okay. So account keeping is important. If you have mentioned in a particular clause of a company that there is power to purchase and sell shares, because that could even be an investment or it can be even as a stock in trade. So you have to, this could alone not be the decisive factor. You have to maintain books of accounts and follow the regular treatment that you have to be given up in order to decide whether it is share or a capital asset. Quantum of purchase and sale. So if we talk about investment, we are buying it in a particular month and selling it after 6 months, 8 months, 10 months, 12 months. So this is what investments actually is. More or less, we are not doing it on a simultaneous basis. If we are seeing the books of a person who is into intraday trading, we are saying on a daily basis, he is executing hundreds of transactions and on the same day, he is squaring off hundreds of transactions. So the quantum of sales and purchases makes it quite evident that whether this particular transaction is a business transaction or it is a capital asset transaction. So that forms also a very good premise of deciding whether it is a capital asset or a stock in trade. Next, ratio between sales and purchases. If we talk about the transactions where we talk about investments, so the ratio between sale and purchase would quietly be same, would quietly be like you're purchasing it on one part of a year or a month and you are selling it off on another part of an year. So the ratio would eventually coming up to be the same. However, it would be in a gap of very much time. If we talk about, if in case of a business income, like stock in trade we talk about, so the ratio between purchase and sale would always be equal. Like you're buying 60, you're selling 60, buying 70, selling 70, selling 70, buying 60, buying 70. So that would be on a coherent basis and the ratio would always be equal. So that ratio also becomes a decisive factor. Third, next is the holding period. Now, if you are holding an asset for, say, suppose more than 12 months, so it is again like more of an investment, or if it is near to 12 months, it is also an investment, being a short-term asset itself. However, you could also be of the mindset that you are into trading only, but you are holding this particular stock because you wish to trade it on a later period of time. So the holding period also forms an important criteria of whether deciding whether this particular asset is a capital asset or a stock in trade. Next, if objective is to earn dividend, then it is always a capital asset. Obviously, if you are keeping an investment of reaping interest or dividends out of it, then the particular asset becomes your capital asset and never as a stock in trade. So if the objective is this, you're reaping dividends, then it is always a capital asset. Next, method of valuation. Method of valuation of stock in trade is very much given in the PGBP, and for the capital assets also it is being well defined. If you are following the premise of capital assets, then you cannot take it as stock in trade. And if you are following the premise of stock in trade, you cannot classify it as a capital asset. So whatever you have to treat it, you have to follow or establish a particular chronology of events. You have to maintain detailed books for it. You have to maintain separate accounts for it. And the next point that is coming up is it is possible to have one portfolio as investment and the other portfolio as stock in trade. So say suppose you are opening two Demat account of a particular client, one Demat account with ICICI say, and the other Demat account is with HDFC. In the HDFC one, you are executing the trades on a regular intraday basis. And in the ICICI one, you are maintaining the trades that are being executed in the investment cycle. How good is it to establish it in the front of AO or the government agencies in the coming time that this is my business portfolio and these all stocks are my business stocks or the stock in trades, and these ones are my capital assets or the investment stocks. We could give a complete discussion. We could keep an explained reply for the same if we maintain two portfolios. So what I have done after reading this particular circular back in 2015 and 16, I advised all my clients to maintain two portfolios if they wish to execute transaction. And from the very time we have become, I mean, it is always good for the CA to get the details that are bifurcated and they don't have to spend time. Even if we check up the annual information statement, the AFS that has been coming up, so you see the transaction remarks are also being given in those particular transactions, that whether it is short term or long term. We can ignore those particular remarks if we are maintaining a profound system, like if you are maintaining two portfolios, two different accounts for the same to establish it in the future. So that could also be ignored once, because whenever a notice is coming up, we have a full-fledged explanation for the same. So it is always good to maintain the back paper completely and follow a consistent approach. It can be two-way, like one portfolio investment, one portfolio for shopping. Whether such shares have been purchased out of own funds or of loan taken. So investment is always out of your own funds, and the stock in trade or the investment, the stock in trade or the business trades are always of loan taken. You can very easily establish the premise that we have taken loan and bought these particular shares, that is for our business. The assessing officer would definitely agree with your point. However, if they are all your earned funds and you are investing them in stocks and then claiming them to be stock in trade, you can do so if you follow all the above steps that have been given up. But that could have a nature of considering this particular shares as a capital asset and not as stock in trade. All these factors together has been lined up in a way back in 2007 to give this particular impact. Even till date, till 2022, we are in the dilemma, and it is a board circular. Like the CBDT is obligated, or the assessing officer are obligated to follow this particular approach. So we don't have to worry. We just have to go consistently with circular 6/2016 and 4/2007, and things would be much clearer. Till the time it is considering the shares as a capital asset or as stock in trade. I guess this would have been much clear in the minds of all the professionals who are connected today with us, that how classification has to actually be done. Now it's a second board circular that I am discussing, that is transaction in share held in dematerialization form. This must be very much clear that we have to follow in the FIFO method for that particular client. FIFO method will be applied only in respect of dematerialized holding, because in case of sale of dematerialized the share held in physical form cannot be considered to have been sold, as they continue to remain in possession of the investor and identified separately. So in physical shares, you can follow a chop shop approach. In case of dematerialized holding, you have to follow a FIFO approach. In the depository system, the investor can open and hold multiple accounts. In case where an investor has more than one share account, FIFO method should be applied account wise. So say suppose the investor is having three accounts, one with HDFC, one with ICICI, and one with SBI. Now the person has sold this particular stock, and the stock is in all the three Demat accounts, and they are not linked together because they are of different depositories. So he has sold these shares from the HDFC account. Now the FIFO method would be applied to the HDFC account only, and you cannot say that we have bought these shares the SBI rate priced one which we bought. However, coherently the shares are yours, you can do it. However, you have to apply for the purpose of the calculation. You have to always follow FIFO account wise for your clients. If in an existing account of dematerialized stock, old physical stock is dematerialized and entered at a later date under the FIFO method, the basis for determining the movement out of the account is the date of entry into the account. Okay. So say suppose your client has physical stock of shares in his hand, and now like after 5 or 6 years, the company was earlier delisted or was not working regularly, properly. So he had the physical shares, and now he has dematerialized those shares because the company has revived or has started back the operations or is relisted. In that particular case, whenever those shares are coming back into the account, so the basis for determining the movement out of the account is the entry into the account. Okay, so that has to be taken up like when the old physical stock is getting dematerialized or later date. So there are already shares that are lying up in your account, and these shares were also but in physical form, and now you have got them dematerialized. Okay. These were the two board circulars, CBDT circulars. We have covered up entirely the transaction of sale of shares. Finally, we are moving towards income from other sources on sale of shares. So this is a small topic that I have covered up, and I know many of you would be aware about it, but just for the purpose of our basically coverage, I have covered up. So section 56 to 10, a much like a section that is in much debate by everybody, because it is creating really mess with each and every asset that has been defined up, that is of gift of exceeding 50,000 rupees. So wherever any person receives in any previous year from any person or persons, property being share and securities. Again, I have limited the coverage just to shares only. So property being shares and securities with consideration if FMV of such shares exceed the purchase price by more than 50,000 rupees. So you have paid the consideration. However, the total consideration or the FMV that was payable was more, and the differential was more than 50,000, because we know that gift to a totaling of a 50,000 rupees in a financial year is exempt, received from anybody. Okay, so if it's with consideration, the gap between the FMV and the actual payment is more than 50,000, then you will be getting a covered up here. The aggregate FMV, that is of the share, minus purchase price that you have paid, will be considered to be your income from other sources. And if it's completely without consideration and such consideration exceed 50,000 rupees, then the entire aggregate FMV of that particular share will be taxable under the income under head other sources. So your share sale transactions could also be coming up, or they can come up under income under head other sources under section 56 to 10. So you have to follow these provisions quite clearly. Exceptions shall be applicable, that is if it is received from relative by will or inheritance or by marriage, that have been given in 56 to 10. So that exceptions would continue to be applied even on the property held as stock or shares or securities. Okay. Important note is that section 56 to 10 will have application to the property which is in the nature of capital asset of the recipient, and therefore would not apply to stock in trade. So if it is a stock in trade, 56 to 10 would never come in picture. It will only come in picture when you are treating that particular capital asset, when you're treating that particular share as a capital asset. So this is an important note for 56 to 10. Danji, now we are coming up with speculative transactions. So this is the last point of our discussion for the today's webinar. So speculative transactions, quickly, we are going to understand the brief background, that why we have to really understand what is speculative transaction or speculative income. So income tax provision includes taxing any kind of income earned by taxpayer, categorized under 5 major heads. We know salary, income from house property, profit and gains of business or profession, income from capital gains, and income from other sources. The right classification of income plays a very important role due to varied method of computation, deduction, incentives, and tax rates that have been prescribed. There has been also been a confusion and a controversy with respect to the classification of income between business income and income from capital gains in case of commodities, including stock and shares, even after various circulars, decisions, etc. There are various decisions which have held that classification between those two categories of income must depend on intention of investment, just like we have discussed in circular 4/2007, and frequency of transactions. Further, if a transaction is classified to be business, it calls for further classification as the income being speculative or non-speculative, and that is where speculative transactions or speculative income is also much of a resource to us. What is speculative income? So income tax provision have not defined speculative income, but have defined speculative transactions. However, it should have defined speculative income because tax is always on income. But to a wider coverage, they have explained speculative transaction. Therefore, it can be said that income that is derived from such speculative transaction would be speculative income. So that is a deemed assumption. So section 43(5) subsection 5 is there, which talks about speculative transaction to mean a transaction of purchase or sale of a commodity, including stock and shares, settled otherwise than by actual delivery or transfer of commodity or scrip. There won't be any excuse me, there won't be any actual delivery or transfer of commodity or scrip. Example, In the case of intraday trading in shares, there is no actual delivery as the shares enter and exit from the trading account on the same day, and it does not enter the demat account at all because the trades are squared up on the very day they are purchased up before 3:30 p.m. Intraday trading is the trading of shares within the same day. Generally, the delivery is not taken in the case of intraday trading. Thus, they are called speculative transaction. Intraday trading is called speculative transaction. Therefore, based on the definition, it can be inferred that intraday trading income is a speculative income. So this is also kind of a conclusion that we are drawing up, that whenever the income would be intraday, that would always be speculative in nature. Okay. So there are certain exceptions to what a speculative transaction would be called as, and these are the following exceptions. Hedging contracts in respect of raw materials or merchandise. So this is the profound explanation to it. You can read it once we are sharing up the slide. I'll be taking up the ones that are relevant to us, that is with regard to shares. So hedging contract in respect of stock and shares. This is the contract in respect of stock and shares entered into by a dealer or investor to guard against loss in his holding of stocks and shares through price fluctuation. So what we do is sometimes we hedge the contract in a way that where we are expecting the price to increase, we buy that particular share. And on the second side, where we are expecting the shares to fall up, so we buy that, sell those particular shares. So this is where we have automatically hedged this particular situation, that out of this transaction, we will definitely gaining up. And where we do this certain kind of hedging in stock and shares, and this hedging is also always done in F&O market, that is forward market of the future and option market, and it is never a delivery market. So the exception of a speculative transaction would be hedging contract in respect of stock and shares. Next would be a forward contract. So forward contract is in a kind of a jobbing nature. If I say about the currency specifically, so in case of a currency, what we do is we are about to get certain dollars from a foreign market. So what we do is at a future date where we are going to receive those particular dollars, we are happy with the price that is going currently. So what we'll do, we'll buy a forward contract today of that particular price. When we receive that particular currency, we'll sell that particular forward contract and square up the transaction. So this is where a forward contract is, however, speculative otherwise, but it has been given a specific impact of an exception from speculative transaction. And if there is any income that arises from such transaction, then this income would be non-speculative. Okay. Trading in derivatives. When we talk about derivatives, derivatives are future and options. Okay. So whenever you are making any transaction in derivatives, it is never speculative. Intraday is not derivative. Intraday is without delivery, but in your spot market or the delivery market. However, you are not taking the actual delivery. Derivative market is your F&O market. So all the trades that you execute in F&O market and you are getting, and you are squaring it up on the last Thursday or before that. So for all those particular transactions, the trading in derivatives, the income that is rising from there, it is not speculative. So this is as per the exceptions that have been provided by the government. Trading in commodity derivatives, just like stock derivatives, there are commodity derivatives which talk about selling and buying of commodities, being copper, metals, or like other resources, other things that are being traded. Everything like being of a commodity, like being aluminium, iron, copper, the metals, or even being the aloo, pyaz, tomato, tomatoes, everything, every asset is being, every item is being treated as a commodity, and the derivatives are being performed. Even gold and silver is also a commodity derivative. So whenever it is carried out, it is never considered to be speculative. Next is about the treatment, like how would the speculative transaction or speculative income be treated. Speculative business has to be always treated as a distinct business. If a taxpayer is carrying out many businesses along with speculative business, such speculative business of taxpayer must be deemed as distinct and separate from other businesses carried out by the same taxpayer. Why? Because treatment of loss from speculative business is absolutely different. So treatment of speculative business as a distinct and separate business is necessary for the purpose of set off of provision. As per section 73, loss from speculative business can be set off only against profit from speculative business, unlike loss from business, which can be set off against profit and loss. Further, the loss from a speculative business carried forward to a subsequent year can be set off against the profit of gain of any speculative business in the subsequent year. Along with treating speculative business as separate and distinct business, profit and loss resulting from speculative transaction must also be treated as separate and distinct from the other profit and gains of the business and profession. loss from speculative business cannot be carried forward for more than 4 years. In case of other businesses, it can be carried forward till 8 years. So this is the distinction we are talking about. Further, if depreciation in capital expenditure on scientific research, if any, incurred in speculative business is being carried forward, such depreciation capital expenditure shall be set off first. So that is where the distinction or the separate entity of this speculative business is important, because the treatment of various of the set off or carry forward provisions are there in the act basically, and that is why a distinction has to be maintained. Summing up everything, summing up this speculative transaction, I have prepared a conclusion table. So if a transaction would be an F&O in shares, it would never be a speculative transaction if the transaction of F&O is eligible transaction and carried on a recognized stock exchange. F&O on commodities on the same line, never a speculative if it's eligible and if it's on a recognized stock exchange. Normal trading is share, that is delivery based. So not a speculative transaction, either taxed under the head capital gain or PGPP, depending upon the nature of holding and nature of business. We have discussed about this in detail. Intraday trading, speculative transaction. The income arising from the intraday trading is speculative income. Next, forward contract is currency. Again, a forward contract being the one covered in the exceptions. So not a speculative transaction. Arbitrage trading involves simultaneously buying and selling the same assets across two different markets. So you are buying in BSE, selling in NSE. Profiting from the price difference. Hence, technically delivery is taken. Therefore, it is normal business and not a speculative business. Because when in one market you will buy this particular stock and sell that same particular stock in the other market, observing a small arbitrage difference of 1 rupee or less, even less. So that is done by algorithms these days automatically. So when you are conducting these transactions, once you have executed the buy trade, so you'll have to take the delivery in T+1, T+2. And once you have executed the sale, you have to release that particular delivery in a particular market. So you will be taking the arbitrage gain. And once the delivery is taken, the transaction becomes in real nature. And once in real nature, it cannot be termed as a speculative transaction. Dabba trading. Off-market trades that are continued or are considered to be illegal, that are done gray market, what we call as, like after the stock market ends, we do the dabba trading. So that is purely speculative. However, this is illegal and prohibited by SEBI. So people can do it. However, it's considered as speculative because income tax has nothing to do with whether the transaction is illegal or not legal. Tax is payable. If it is taxable, the income tax would be leviable and chargeable and collected. So for the purpose of that particular thing, this is speculative transaction. With this, I conclude today's session. Thank you so much, everybody, for listening to me. Even small break today, I guess we have extended the discussion but we have mostly profoundly covered everything about sale of shares. I mean, all the heads, everything we have covered up, and also talked about the speculative transaction also. So over to you, Rohit.
Thank you so much,
everybody.
Sir.
Now we are free to take doubts. Yeah.
Thank you so much. And I can see few of the comments have been appreciating today's presentation. So obviously, need not mention it, as there might be many beneficiaries from today's session. So thank you so much for this. Thank you so much for this insightful session. And PPTs will definitely be provided. So don't worry. We'll be arranging it as soon as possible. And
sure.
Yes,
that I'll be sharing it with you today itself, so that you can very much like update it in today's video itself on your website. Okay. And if there are any doubts, feel free to contact me anytime via email, or you can also write to Optotax, and through them you can contact us. Thank you so much, everybody, for like such appreciating words. I guess it is a Sunday. I have always already taken 1.5 hours of your like a blissful Sunday, and also open up my Sunday to an extent. So whatever your questions are, you can share it in future. Be taking up all those questions. I guess, Rohit, for today, it's really efficient that we have already covered up, and we are already running late on time. Okay, so thank you so much. So you can conclude the session, Rohit.
Yes, okay. So thank you so much for your love and support, people. Because of your love and support, we have been organizing many seminars and webinars like this, and we are soon bringing a webinar on bank audit. So please stay tuned, and dates will be released soon. Please stay connected. Keep using Optotax. Be safe and healthy. Keep hustling. Bye bye and good night. Your queries will be answered directly on mails if they are required. Thank you so much.